Thanks, Rachel. Now, when considering whether we would lend to 21st Century Fox or Time Warner, we would take into consideration their leverage and solvency ratios. First, we would look at the capital structure leverage. As we know, this measures the extent to which a company relies on borrowings in order to run the company. At 2.98, 21st Century Fox has a fairly high capital structure leverage, which means that we know that they rely on these borrowings, which helps us feel comfortable on lending possibly. But we would of course want to look at their solvency ratios to see how well they are at paying back their liabilities. Now, the current ratio compares current assets to current liabilities on the balance sheet, and at 2.12, 21st Century Fox's is relatively high. This means that they have about $2.12 in assets for every liability that they have in their balance sheet. The quick ratio provides a much more stringent test since it removes current assets such as inventories and prepaid expenses before doing the calculation. And at 1.51, theirs is still relatively high. Taking all three of these ratios into consideration, we would feel confident in lending money to 21st Century Fox. In comparison, looking at Time Warner's leverage and solvency ratios, we see that they have a similar capital structure ratio of about 2.71. So we do know that they rely on borrowings as well. But their current ratio is 1.39 and their quick ratio is 1.06, which is not quite as high at 21st Century Fox. So they don't manage their liabilities quite as well. This is why, taking the two in comparison, we would rather lend to 21st Century Fox as opposed to Time Warner. Now, when considering which one of these two companies to invest in, it becomes a little bit more difficult because we only have the 2016 data to look at. But first, we will look at some performance ratios. First is Time Warner. Their 2016 performance ratios look like this. They had an earnings per share of 501 and a stock price return of 52%. Now, this is because at the beginning of their fiscal year, they had a stock price of $64.67, and by the end of the fiscal year, it was up to $96.53. And along the way, they paid $1.61 in dividends. Their price earnings ratio sits at about 1927, and that means that, and from the 2016 data, that the market feels fairly comfortable that they are a high growth company. Now, taking these performance ratios into consideration, along with the fact that Time Warner's stock has grown from $20 in 2009 to $90+ in 2018, we feel that they have a fairly strong momentum going, and we are fairly confident in investing in Time Warner. Now let's look at the 2016 performance ratios for 21st Century Fox. As we can see, they had an earnings per share of $1.54, and stock price return was actually negative 16%. This is because it took a dip in 2016. Their overall stock price of the last 10 years that we saw actually was showing a significant trend up. So this could have been just a temporary decrease in this year. They do have a price earnings ratio of 1753, so the street is still kind of feeling confident in investing in 21st Century Fox. And this is why we feel that 21st Century Fox would be a good investment because their price is low right now. And if you feel confident in their trend going up like the street does, this is why you'd want to invest now.